All right, why don't we kick off? We've got our attendees joining. A very good day. Welcome everyone to the Wall Street Blockchain Alliance's special webinar on GameStop, DeFi, and the future of financial markets, understanding current market turmoil and future challenges. My name is Ron Quaranta. I'm privileged to serve as chairman of the board of the Wall Street Blockchain Alliance. Before we start, a little bit of housekeeping for this webinar. This webinar is being recorded. All attendees will be in listen-only mode. We will be accepting and reserving time both during and at the end of the presentation for Q&A. Please enter your questions in the Q&A section and panel so that I and the panelists can review as well. And while we're at it, I do have to read this disclaimer to you because I know way too many attorneys. This event is offered for general information and educational purposes only. It is not intended to constitute legal, tax, accounting, or investment advice. All information or opinions shared during this event by the WSBA or any participants is solely for information purposes only, and any views expressed by participants do not necessarily reflect the views of their respective firms. In addition, anything discussed or shared during this event shall not be considered investment advice, recommendations, or solicitations to purchase or sell any securities that may be mentioned during this event. The WSBA does not provide services as an investment analyst, advisor, broker-dealer, market maker, investment banker, or underwriter. With that, one other thing to bring up, unfortunately, we will not have Rebecca joining us today, unfortunate circumstances, but hopefully we'll get her for next time. And to kick off, we're going to start a little bit with David and I, my dear friend David Brill, who chairs our crypto asset working group, chatting through some what we call the fireside chat around some of the issues that are happening in this space. And David, you and I have been talking about this for some time. We've been involved in this space for many, many years. One of the things I wanted to raise as part of the conversation for you and I to kick off is the real challenge around the takeaways of the events that are happening in the marketplace. We've seen we've lived through the dot-com bubble. You and I have lived through the ICO boom. We've seen these kind of challenges. Talk a little bit about what your thoughts are on what you're hearing in this space as well. We'll talk about GameStop. We'll talk about that kind of market structure challenges in this space, but weigh in on what you've seen in the past few weeks. And once we do some of that, we'll also launch a poll before we bring the panelists in as well.
So Ron, thanks. And thanks everybody for joining us today. We know there are a lot of people out there and we're looking forward to some really special, insightful content for everybody to take in. So, this is a multi-dimensional issue, Ron. I think at the core, you saw with GameStop this asymmetry between traditional institutional investors taking positions, retail investors fueled by Reddit and some different options want to take a different position. And we saw the underpinnings of our markets get sort of challenged in the sense of the rapidity and the volume of options and the trading in these certain securities created these really sort of existential problems for certain parts of our trading markets. And what I'm referring to in particular is the whole clearinghouse part of the equation and margin requirements. So as we saw, certain trading apps, Robinhood and others, had to stop allowing their customers to invest because they could not keep up with the amount of margin required for these clearinghouses. And so this kind of plays into the idea of how fast should a transaction actually settle? And in our country right now, it's T+2. So when you layer in the margin requirements that some of these online brokers had, plus the T+2, it created this combustible mix where we really didn't have an efficiently traded market system during this high volume crunch. And I think people look at that and they go, when they look at DeFi and the promise that decentralized finance brings, a lot of these problems go away. And I think in part, that's why people are so excited about DeFi. And obviously, as this panel goes, we'll talk further about how DeFi deals with those issues.
David, I want to expand upon that a little bit. And you and I've fireside chatted probably several hundred times in our time together in our careers. To me, it really reflected a lack of understanding of the nuances and complexities that underlie the financial markets as we know them. There's what I'll call the retail or common perception of what happens in the marketplace, but there's literally no understanding of things like hypothecation, stock loan, stock borrow, custody, and margin requirements, and on and on and on. And as we begin to see what I'll call the gamification or the more retail broad-based adoption of investment capabilities and the UX that allows for that, it really brings the catalyst for DeFi adoption over time to the fore in my mind. And some of this will be a little bit of archaeology on GameStop. I know some of our colleagues here know more about it than I certainly ever will. But it really is the opportunity to ask the question that I often ask, which is, how do we do what we do? And why do we do it that way? And why does it need to change? How will that marketplace change when every American or billions of people around the world are able to trade different types of tokens and assets? Are you of the same mind? Is this kind of catalyzing of DeFi critical to DeFi adoption, or is there something more simple going on here?
Well, I think it's both, giving you a lawyer answer. I think it's both. In the first instance, when you look at credit and who has access to credit, in these traditional markets, the institutions have the largest access to credit. And that access to credit, whether it be selling shares short, whether it be naked put positions or aggressive options positions, institutions typically have the widest amount of credit available. Where that changes is in DeFi. In DeFi, individuals can have credit really related to the amount of holdings they have. So if I were to use an online platform, like we'll say Nexo, and I deposit 1 BTC into Nexo, I have somewhere between 50 and 70% borrowing capability against that 1 BTC. And obviously it's dynamic, it moves. If the BTC moves up, the amount you could borrow is higher. If the BTC moves down, the amount is lower. So what's so interesting about DeFi is it almost flips the table, where credit is most available in the institutional space in traditional markets. In the crypto markets, credit is readily available to the individual space, and less so in the institutional space, because that part of the market hasn't developed as much yet.
I want to turn the other side of that around as well to review, right? Because we talk about it from the investor perspective and the investment capabilities. And again, David, just doing a little bit of the archaeology.
Sure.
And I know we're going to bring this up a bit later, and I don't want to make it a payment for order flow conversation, but it's important to realize that the economic models by which financial markets, firms, and institutions engage and how they make their money over time is truly being disrupted and needs to evolve. Have you had that conversation? What are your thoughts about that as well? And certainly our panelists are going to touch on that. But that really got brought to the attention of a lot of my colleagues in financial services, who suddenly realized my role's changing, my company's changing, and it's not going to be here like this in 10 years. What are your thoughts about that?
So when you look at services, and a lot of people who've traded securities for a while, the fees have gone down. So it used to be a percentage of the transaction, or the actual flat trading fees used to be whether $39.95, $29.95, and it's gone down. Mm-hmm. When you realistically look at getting free stock transactions, there is a price. Besides the administrative price has to be paid through the whole infrastructure process, there's a price to be paid for it. So I don't believe that it should surprise people that if you're getting free trades on an app, somebody is paying for the order flow from that app, and you're not getting, in all cases, best execution. So I think the analogy I like to look at is we get free services from other technology companies. We get free services from Google. We get free services from Apple. We get free services from other technology companies. Part of it is, in those cases, they're mining our personal data, and in return, they're giving us this robust infrastructure to look at. On the trading side, it is they are being paid for their order flow. And that is the trade that you make between getting a free transaction and someone on the other side benefiting from that by, receiving compensation for that order flow.
Right. Thank you, David. And again, I do see the chats coming to the panelists and appreciate that from everyone. Before we bring on the panelists, and I'm going to actually stop screen sharing for a moment because I do want to give everyone the opportunity to be recorded. We did also create a poll, and I wanted to offer the poll for our attendees, which will be interesting to see. I'm going to allow the panelists to vote as well because some of you are experts. But what is your level of knowledge regarding decentralized finance? And we go through the gamut of I'm a DeFi expert to what the heck is DeFi, and I'm curious about how many experts there are in this space. And David, we usually let these kind of panels, these kind of polls go for a few moments, though. I think the one thing I do want to bring up as well, and we do these very conversationally, is I don't know many DeFi experts. I know a bunch of self-proclaimed DeFi experts. How is that evolving? How does that have to change?
Well, look, I think there's kind of the practical and the theoretical level. I think there are a number of people who understand, what it is, what it looks to accomplish. But in my mind, the real expertise is gained by going on the different platforms, pooling tokens, staking tokens, and really going through all the different steps that are available to really understand the ecosystem. And like for me, I go on many of the different sites, and it's not always staking in volume, because some people will say, well, I'm not sure how safe or stable they are. But it's really getting into the weeds, to understand the intricacies, and to understand things. For instance, in some platforms, you can stake your tokens and get a nice return, but if the Ethereum gas price is high, it's going to take away from your return, because you're getting a return of X, but then your fees may be 25% of X. So I think the real expertise comes with understanding at a high level what is looked to be accomplished by DeFi, knowing the players in the space, and then actually using the projects and doing the ROI and really understanding on that fundamental level what you're getting.
Thank you, David. And we just ended the poll. Apparently, we have 3 folks who are attending who are DeFi experts. I'm very curious what those people were. As we suspect, and as you and I have discussed many times, everyone's kind of familiar about the recent innovations. And I would argue that some of the innovations are moving so quickly that it's hard to stay abreast of those. But I'm going to stop sharing those polls. I do want to transfer over to the panelists now real quickly and give them an opportunity to introduce themselves briefly. Pat, can we start with you?
Hi, Ron. Thank you, everybody. Can you guys hear me okay?
We can hear you fine.
Okay, great. Just before I start, I do want to say that these are my personal views and do not constitute a recommendation or endorsement of any particular security or strategy just going forward. I was required to say that. So now to get started. I'm a co-chairman and CEO of Oasis Pro Markets. We're a digital security ATS. We're a FINRA broker-dealer, and we submitted our Form ATS with the SEC. We are digital cash payments for digital securities, and part of everything that's already been discussed is along the lines of what we saw in the market a couple of years ago, the movement from T+5 to T+3 to T+2, and we'll talk a bit later about today's news regarding DTCC and their new strategy to go to T+1. But we're more focused on the blockchain and utilizing DLT for T+ seconds.
Thank you, Pat. Mr. Murphy.
Thanks, Ron. Thrilled to be here amongst such esteemed panelists. I hope I can pull my weight and hold my own. My name is Greg Murphy. I'm the Director of Enterprise Development at Polymath. Polymath is a security token blockchain developer. We are building a new blockchain specifically for security tokens on Substrate. My background is 35 years in capital markets. I know I don't look a day over 35, but that's fine. And much of that was involved around securities lending, derivatives, and structured derivatives. I've set up 4 broker dealers in my life, 2 of them in Canada, 2 of them in the UK. And more recently, before I got involved in the blockchain space about 4 years ago, I was operating a fund that was dedicated to securities lending in a weird kind of way. And this is quite applicable to this because it made me not like completely and fully understand the different settlement cycles around shorting, borrowing and lending. Not that I didn't know it already before that, but also that the issues around trade versus settlement and the disconnect there. And this became very evident in the recent GameStop and other shares that were being pumped up by Reddit users, and how now this is manifesting itself in the potential to now go to T+1 as DTC said earlier today, which I scoff at, and going to T plus seconds to eliminate some of the problems that Robinhood and indeed other broker dealers had. So I look forward to getting into the weeds on that kind of stuff. Thanks.
And Greg, I just want to point out, don't you get some type of prize for setting up 4 broker dealers or some kind of Nobel Prize?
I wish I did.
Mr. Johnson, old friend.
Hey, Ron, fellow panelists, good to be here. Thank you very much for inviting me. My name is Richard Johnson. I'm the founder and CEO of Texture Capital. I've been in the securities markets for over 20 years now. Started off in 2000 in electronic trading, back when electronic trading was less than 10% of the market, and now it's basically 100%. So had a good ride there, worked at 3 different banks and brokerage firms up till 2014. That coincides with about the time I discovered Bitcoin, and I went down that rabbit hole. Did some consulting in the space for some crypto companies, and then spent 4 years at Greenwich Associates as a market structure analyst covering equity market structure and crypto and blockchain, which is how I kind of ended up in the securities token space, digital securities token space. It was, if you cast your mind back to the ICO bust of 2018, and Jade Clayton came out at the time and said, every ICO is a security, these platforms need to be regulated. And I very much agreed with him, but at the same time, I took it as a call to arms to set up a broker dealer to help firms issue regulated securities on a blockchain and help investors trade those tokens in a secondary platform. So started thinking about Texture and eventually putting pen to paper and moving forward with it. We got our regulatory licenses at the end of last year. We're a FINRA member, SEC registered broker dealer, and ATS. We focus on issuance of digital securities as private placements, tokenization, and secondary trading through our ATS. It's a very exciting time with all this going on. And it's particularly exciting for Texture as we launched our own security token offering a couple of weeks ago, which is available on our website. And I'm looking forward to this discussion.
Thank you, Richard. And I think all of us have been around long enough to remember when evolution in Wall Street and electronic trading was, we're moving to a Windows-based trading platform. Those of you who remember the old days.
I've got some stories about, we get a fax come in and there's a 5-page program trade and 5 people would take 1 page and type it in and then send the orders. That was electronic trading. So.
Oh yeah, I remember. So I want to kick off, and we've got, for the attendees who have joined, please do continue to submit your Q&A. We'll start addressing those as we move further along. I want to frame the situation a little bit, and I've spoken to all of you. I know all of you well. I've had colleagues in industry who, in the GameStop Robinhood quote unquote fiasco approached and said inefficiencies in the market, but people don't understand, and some of the stuff we referenced earlier, custody and settlement, that disconnect between trade and settlement. I've also had industry colleagues who have approached me and said, this is the little man being disenfranchised. It is David versus Goliath, storm the Bastille in some instances. Greg, I'd love to start with you if we could, because we had some very deep conversations as groups, even in the happy hour, believe it or not, around what really happened. And I don't want to take too much of the time here for the entirety of the session, but in your perspective, what was the real breakdown that forced a Robinhood, and to be clear, Interactive Brokers and some of these other brokerages, to place halts on certain trading and buying and selling of certain securities?
Sure. I'm actually glad that you identified the fact that it wasn't just Robinhood that did this. And I'm not a trading expert like Richard is particularly, but there are, when a broker dealer has clients that do trades, they have to post a certain amount of collateral with the NSCC, which is a subsidiary of DTC, which supports their ability to settle the trade in 2 days' time. So there's your first disconnect, as I mentioned before. Now, during that time when the trade happens and the trade settles, if the volatility becomes crazy, or or the market prices, well, again, let's just call it volatility, then the NSCC asks the broker dealers who are involved, based on their risk profile and the and the securities that are being traded and settled through that to possibly post extra collateral. That happened to several dealers, not just Robinhood. So they could do one of two things. If they had extra collateral in their, in their coffers, which very few broker dealers do. Broker dealers are very efficient at utilizing their collateral, be it, bonds on repo, securities and margin accounts. They're very efficient at maximizing their value. So they had to go out and basically raise more capital. Other companies had extra capital around or what have you, and didn't need to necessarily do that. So that was really what happened, and why they ended up stopping it, at least as I'm aware, and I'm happy to be corrected. Well, not happy, but you know what I mean. But and so that's the real problem with the T+2 settlement. Now you roll into broker dealers that are allowing shorts, or there's a short squeeze happening, and both Richard and Pat wrote terrific articles of late, like in the past few days actually, about how that happened, and the and the possibility of having more than 100% of the shares short, and those kinds of things. But it began to feed on itself, and the problem was, again, that as it feeds on itself, excuse me, the settlement systems being 2 days late, and on a net basis, not on a real-time gross basis, on a net basis, you can actually have a seizure of settlements in a particular name. And I've seen it before. This is not particularly unusual. Several years ago, some highly shorted stocks that were very expensive to borrow, which I was involved in, it had the same problem. So when people were buying them, they weren't necessarily getting delivery. Not that they weren't buying from a short seller who couldn't borrow it. They just were buying it from somebody else who maybe had lent it out to a third party and couldn't get it back in time to make settlement, or whatever. So the settlement system seizes up, and it is actually quite interesting, because even a few thousand shares available to be moved between one other person can whip round the system quite quickly and unseize that. You have another problem in that if there was a stock that was short and people and broker dealers or whatever were buying them, they were never guaranteed delivery, notwithstanding if it was a long seller, because it may have been lent out by their brokerage firm from their margin account, which brokers do. They lend out long securities that are held on margin. They lend them out. That's how they maximize their value. They couldn't get them back in order to settle. That's the first problem. Second problem is that if there were even buy-ins, of which I'm sure there were plenty, buy-ins are not guaranteed settlement. So a lending broker who is going to buy in somebody who's short says, okay, I'm going to take your collateral, I'm going to liquidate it, I'm going to buy the securities, and I'm going to close out your short position. That doesn't solve a damn thing, because he's not necessarily going to get delivery. And then Richard and I and Pat can go on about Reg SHO until the cows come home. But we'll do that another time.
I want to give Pat and Richard an opportunity to weigh in there as well. And just real quickly on the articles and papers that Pat and Richard have written, everyone who was invited and all the attendees should have gotten both the bios as well as the articles. They're really worth reading. Please do. But Richard, Pat, weigh in. And I do want to address one of the Q&As that we got, and we'll come to the others a bit later on. But one of the interesting perspectives was why the stoppage only from public perception on one side of the book. So Richard, I want to give you and Pat some bandwidth, and David, please chime in as well.
Just reading the question here. Why was the stoppage only on the buy side? Well, that's because the trades need to be funded over the 2-day settlement cycle. And what happened was we had a lot of Robinhood traders and other traders buying GameStop. The collateral requirements are based off a couple of things: notional value that is, pending throughout those 2 days, and also the volatility of the stock. Both were very high for GameStop. So Robinhood and others got a capital call, or not a capital call, whatever the termination, a collateral call from the DTCC saying, you need to post more money because you've got a hell of a lot of GameStop trades waiting to be settled over the next couple of days. Robinhood didn't have that capital at the time, as did and others didn't also. So what they did is they stopped people buying. Basically, that reduced their collateral liability, but buying would increase their collateral liability. So stopping buying would prevent it going up anymore, whereas selling would reduce it. So selling was good for them. So that was why it was on the other side. It was selling would balance out some of the risks they had through that settlement cycle.
And Pat, just to weigh in and one thing to add to that before you respond, I'd love your perspectives on one of the comments I got from a colleague, which was really interesting in the backdrop of everything Greg and Richard just mentioned was, well, why doesn't DTCC just, cut them a break? It's a volatile time. It's a volatile day. And I think, Richard, your answer answers some of that, because the knock-on effect of doing that would be catastrophic. But Pat, please weigh in, and David, let us know your perspectives on that as well.
Great. Well, I really don't have much to add to the excellent overview that Greg gave and Richard as well. I think that I think the best way to answer your question is the NSCC, or the amount that's held in the fund. If you look at it over the last several years, I believe in 2019, the average daily balance in that fund was about $3 billion. And in December of this past year, it was $36 billion. And Tesla joined the S&P 500. There was a lot of volatility there. I don't have the numbers for what occurred with GameStop, but let's assume it's well over 40 at that point in time. So that reflects a couple of things: COVID, a lot of people in front of their screens, and what's occurred with Reddit, et cetera. It'll be interesting to see what happens when things get back to normal, when they do, when people get away from their screens. But I think, to answer your question, Ron, the only thing I would add is that why didn't DTCC cut them a break? Well, that's the purpose of this fund. And that fund is there as a safety net. And in regards to the actions taken, it was that the fund was being depleted.
Right, right.
I'll just add one more thing, Ron, which I didn't explain clearly the first time. So what would happen, let's say that somebody didn't manage to deliver. Somebody wanted to buy it, but they didn't have the cash to deliver it. That could have a knock-on effect, because somebody else who'd had another trade in the system was waiting for the money so that they could buy something else in the market. And then, so it might not have been GameStop, could have been something totally different. So that's why they have this collateral pool, to stop these type of kind of snowball effects where everyone could suddenly just start to fail to deliver, and you have a real problem in the market then.
Right.
And then, Ron, from an optics perspective, the challenge that we had was that the online brokers and the other brokerages weren't being transparent to the customers about why there were these stoppages. And in particular, they did not come out at first and say, look, we need more capital to meet our clearinghouse obligations. There was some terms bandied around about suitability for retail investors and some other, we'll call them excuses. And I think the lack of transparency about why the trades needed to be halted added to this frothiness, added to this feeling that the system was, I don't even want to use this word, rigged, but it was stacked against the retail investor. And I think that lack of transparency and handling it appropriately sort of exacerbated the problem.
It's a good point, David. I do want to address a couple of the questions, the Q&As that have come in here, because I think they're critical to this portion. And one, which is really interesting, because when you look at, and some of you may have watched the House Financial Services testimony, and the question is, please address the issues of hedge funds exerting pressure on Robinhood to halt trading. And when you have that conversation, when some of you who watched the testimony, they asked Citadel directly, for example, did you pressure Robinhood? And the answer, rightly or wrongly, was no, absolutely not. We talked to them every moment of every day, but we didn't. I want to open that up to the panel. In your experience, does it make sense for the hedge fund to pressure a Robinhood to halt trading, for example? Or do they need to? And is that popular perception accurate? Greg, do you want to start, or Richard?
I did not hear that hedge funds would pressure Robinhood. I don't think that happened. How would they do that? They may go on CNBC and grumble, which they certainly did. But you put a trade on, deal with it.
Well, and from a regulatory standpoint, all these conversations are recorded at the, on the trading desks. I doubt that happened. I mean, they may have tried, like, hey, I have a suggestion for you guys. Call the maybe the CEO's phone's not recorded, but a lot of these others are on the trading desk. I think the regulators would be all over that. I didn't mention my full background. I used to be a bear at Credit Suisse, et cetera. I just, even in the 90s and 2000s, I don't think that would have happened.
And I think it's the troubling perspective that there's this kind of conspiratorial action happening in the background to protect the hedge funds. I think it's a much more complicated conversation than that.
I think there's something to be said for the potential that the hedge funds and the industry itself, and perhaps, actually not just perhaps, very likely the clearinghouse, was a little afraid at the crowd, and the inability to get to the people that might have been causing this, and which is actually which is actually really interesting in that we always want to talk about the democratization of capital markets, and we want everybody to be involved, and and the SEC, for instance, is there to protect those people and everybody, but whatever. So I don't think hedge funds really played a particular role in telling Robinhood to stop doing things or calling up interactive brokers or anybody else to do that. But I wouldn't discount the inability to understand what the heck was going on.
I want to build on Greg's point. It's also probably the inability in the case of the mass of the retail investors of having somebody to call on their behalf and understand what positions they're taking and why they're taking them. And so that information may have been lacking in the overall scheme of things as you're looking at sort of keeping the market moving smoothly from an infrastructure standpoint.
Mm-hmm. Yeah.
But I do want to reiterate, Ron, that I think the David versus Goliath, a lot of it in part, if you just look at those headlines within a few days, when after this erupted, it was like, oh, suddenly most of retail can't trade right now, and institutional is BAU, is business as usual.
Right.
And those optics, until we got the explanations further on, just sort of fueled that belief that it was one-sided.
Yeah. Just to add to that, I made this comment earlier, the hedge funds, the large institutions, do have an opportunity to call the trading desks. Mm-hmm. Joe retail investor does not have that opportunity. So that probably fueled much of this.
But you used the right term there, Pat. Trading desks.
Right.
Several.
Yep. Exactly.
Not just one. If I'm a client of Robinhood, I'm at Robinhood. Unless I can move my stuff over to Interactive and then trade over there. The institutions have many pipes into the market. The retail individual, not nearly as many.
And I'm going to say that the hedge funds are using, Goldman Sachs and Morgan Stanley, who are better capitalized, and they can throw in the extra collateral to the DTCC when it's needed, so they keep their clients trading.
So I just want to address one more question. We have other questions coming into the Q&A. We will address them. We will get to them. We have a lot of questions coming in. To follow up on the last question, is there any truth that until now there was little countering many funds taking a short position until these retail investors came along? I don't know that that's necessarily true, but I'd be interested in experienced perspectives. Pat, what are your thoughts on that? That there wasn't shorting until there was a retail pool of liquidity, basically to leverage to do the shorting.
Well, I'm not quite sure about that because doing my diligence on this and my understanding of it, I think one of the reasons that the retail started building was that the short position was so large, even at $20 or $10. So in terms of overall market cap of the company, I believe it was over 30% at one point in time, which for a lot of short sellers seems to be a trigger point, as I understand it, but it was over 30% of the outstanding. And as the stock price continued to grow and the roaring kitty was coming out and saying they're completely wrong, ignore the short sellers, and the price continued to accelerate. And then the short position grew from there. There was certainly a short position available. That's my understanding. I may be incorrect, but that's based on my research.
Thank you, Pat. I have one more question here, and then I do want to move to, we'll get to the others. I promised the audience, but we do want to move forward to the core of this, which is really talking about DeFi and the evolution of markets. This one question really stuck out. How is it that reducing from T+2 to T+1 will address the issue with Robinhood? It seems it will only get worse or require more collateral. Anyone want to wait? And I am looking at you, Greg.
You're looking at me.
I think Greg asked that question.
I answered it beforehand.
Yes, you did.
It won't do a darn thing. Let's put it that way. Okay.
Well, Greg.
No, okay. Richard, go ahead. Yeah.
Is half the amount of time. So
indeed.
There will be a reduction in risk, not 100%. But there'll be
but it won't. But it won't. Right. There'll be a reduction. There'll be a reduction in risk to the entire settlement system, making the assumption again that at the time when the broker is required to post collateral, that he can do so.
Mm-hmm.
Now, okay, fine. It stops at 1 day instead of 2. So yes, you have got a reduction in risk, but the requirement of collateral is not going to change.
No.
One last one, which I think is really interesting and was just recently posted, the perceived problem around entities like a Robinhood and others offering essentially free services. And, is that the core of the problem? And I would argue, well, it's no more a problem than you being able to use Facebook for free, for example, or any social media platform for free, where ultimately you're the product. And I would argue that why is that okay? But in trading and order routing, your order flow as the product, which gives you free service, is a problem. I just want to give a couple more moments and then move on. But anyone in the panel wants to address that?
Yeah, this isn't a new thing. I mean, it's been around forever. You trade with a market maker, there's no commissions if you trade directly with them. You pay the spread, and that's how it goes. Your payment for order flow has been around a while. It's definitely not a new thing. A lot of banks use payment for order flow or use the rebates on exchanges. Yep. Where they post for liquidity, they get a rebate, which is about the same level as some of the payment for order flow, to reduce their execution costs, even though they go on and charge their end client a commission. So it's not new.
Yeah. No, sorry, Pat, go ahead.
All I was going to say is everyone on this panel, I think, is old enough to remember the late 90s when the internet craze happened. What's the internet? I remember getting a cell phone in 1995. That was a big deal back then. But we had the exact same thing happening with Yahoo Finance and the message boards, and retail was leading it. I mean, this was like what is old is new again. I mean, it's like redo. So I don't think free commission trading has a lot to do with it. I believe it goes back to this extraordinary time in our history of the last year plus with COVID, people staying at home, getting more interested. What Robinhood has done is more the gamification of stocks than people being drawn necessarily to free trades. That's my opinion.
Greg, let's give you the last. Go ahead, David. I'm sorry.
I was going to say, building on what my colleagues just said, really a lot of it comes down to is that Robinhood and some of the other online brokers didn't take the steps to protect the collateral in the back office that some of their more mature players did. And in some ways, they needed to gamify the sort of knock-on effects of large trading in certain securities to understand what their potential risks were. And because they hadn't done that, or because they hadn't thought through all the ramifications, when this arose, they got caught short. And that ultimately was the problem.
But not advocating for Robinhood, but arguably they modeled their capital requirements and just didn't anticipate a burst through of activity like they would have seen at X 100%.
Yeah.
Well, I mean, yes and no. Like if they're growing their user base day after day, and they're making more and more trades and encouraging them through fractional shares, through limited options, you'd have to realize at some point, you can have some of these sort of high volume events. I think they just Unfortunately, they just were caught unprepared.
Yeah, Vlad, the CEO of Robinhood, when he was testifying on Capitol Hill, he said something like, he gave the standard deviation and said it's like a one in 500 year event kind of thing. And you hear quants throw that stuff out all the time, and clearly it's not. You get fat tails, and these things happen. And yeah, they can do some better modeling for sure.
Yeah.
Let's move on from the GameStop stuff. We can talk about this for hours. Any additional questions, please reach out to us. I want to move forward to DeFi and really this kind of catalyst that I mentioned before around what's happening in markets, kind of catalyzing the ability of DeFi to reinvent those markets and the things that are offered. David, I'd love to start with you. You were privileged to have you as chair of our crypto asset working group. I know you for a long time. Let's level set. What are we talking about when we talk about DeFi? And we could talk about some astounding numbers. I think a year ago, we were talking about $4 billion in locked value. And now I believe we're approaching 50, and I haven't looked in a couple of days. But David, let's start with you. Perspectives, what is DeFi? Why is it important? And how does it move forward from here?
Sure. And I think, all of us have maybe different flavors of how we look at DeFi. To me, when I look at DeFi, it's looking at accessing the financial markets, but not through a centralized party. So instead of going to one of the major banks and seeking a loan or getting interest, opening an account, you have the ability through your crypto holdings to get a whole slew of financial services from different providers who provide different flavors of different things. So for instance, if you are long ETH or long BTC and you want to get some return on that, you have the ability to, stake or deposit, we'll use that word, on a platform, your Ethereum or your Bitcoin, and get a return for that. That we could call that sort of the plain vanilla version. If you want to, be involved in supporting the transactions on a particular network, you can take some of either your Ethereum or the native coin of one of those platforms and stake them onto that platform. And what I mean is, you are a liquidity provider. Trades will be done on platform A, and you are providing Ethereum and some of platform A's tokens to enable liquidity or trades to be made on those platforms. And in return, you get some amount of the fees that are charged for doing those transactions. So there's the ability, really at the most plain vanilla level, to get some interest or return on your main crypto holdings. And then on the second level, there's the ability to obtain some of the fees from helping provide liquidity on those platforms.
And David, just to interject and open up for our panelists, we're talking significant fees on a relative basis in a world where everyone's chasing yield and there's net negative zero savings rates, for example. What are some of the numbers we're seeing there?
So on the plain vanilla, when I say plain vanilla, just you deposit your Ethereum, your Bitcoin, or a couple of other major coins on a platform, you can see 5%, 8% returns. And obviously in this low yield environment, that's attractive, especially if you're long Bitcoin or long Ethereum or the other tokens. When you pool your tokens with others and provide liquidity on some of these platforms, the returns can be really eye-popping. They can be double-digit returns. They could be triple-digit returns. So you have to quantify your risk tolerance. Like on the vanilla end, some of the platforms are fully insured or have a large amount of insurance. On the newer platforms, the risk is a little higher. Yeah. And so they're not sort of guarantees. So you really have to know your risk tolerance and kind of the rewards that you're looking for.
Let's open it up for the panelists. And David, for the panelists' edification, or rather elaboration, are we talking mostly US from the perspective of these decentralized DeFi capabilities, or is it international, is it domestic, or both? Pat, Greg, Richard, love your perspectives on DeFi.
Well, I think David did a great explanation of DeFi there, and I think to me what stands out and what I'd like to kind of comment on is how similar in a way what's happening in DeFi is what happens in financial markets. So we're talking about depositing a token into a lending protocol and then possibly withdrawing, possibly earning interest on it. A lot of these things sound very similar to stock loan, to margin interest, these types of things. So, and that's why I find it exciting, because it's like there's this whole DeFi world who've taken this technology and come up with a brand new way of doing these things that regular financial markets have built up over hundreds of years or 100 years or whatever. And that's so attractive to me, is that, well, let's look at how they're doing it differently, and let's use this blockchain ledger and let's bring it into traditional finance and see if we can improve things like shorting. Yes, we can, because we can track the asset on the blockchain. Let's see if we can improve settlement. Yeah, we can. We can do DVP settlement against a stable coin, and these types of things, and probably other things I haven't even thought of. And I think that's why we're having this discussion today, Ron. Right?
Yeah, yeah. And I just want to, because go ahead, Greg. I'm sorry. Oh, sorry. I want to raise because to be very clear for the audience, the point you all made. When we talk DeFi, we are talking about blockchain. We are talking about smart contracts, and the litany of additional challenges, interesting features, and risks associated with that. So we've talked about security risk. We've talked about, now we'll have to look at Oracle risk, for example, when we look at how these contracts execute. I want to open the floor for some of the panelists. I do want to start addressing some of the questions. We're getting a whole bunch of them in as well. Pat, Greg, any additional thoughts on DeFi? I would love someone to expand upon locked value. I have too many colleagues who simply don't know what I'm talking about when I say locked value, but over to you.
So I'll take this just in regards to DeFi. It's not US only. It's all over the world. Yep. It's in fact, if you follow some of the largest DeFi players like Uniswap, Aave, MakerDAO, et cetera, it's a global phenomenon, not only focused on the US. The one aspect in regards to locked value, I view it very similar to what both David and Richard had sent. I think there are a lot of great ideas in DeFi that can come over to the financial system, and we're working on a bunch of them right now as well. That's why we had done our ATS does digital cash, which is stable coins, to Richard's comment, for digital securities, because we think that improves settlement times, everything we're talking about here. But it's really collateralization. So currently it's for utility tokens, and locked value means for the audience out there that I'm collateralizing my token for instance, and that could be all different types, ETH or whatever, Rapid BTC, whatever it may be. So that's what locked value is. And what's occurred over the last 3 years, and I think David may have alluded to this earlier, was about 3 years ago, I believe the total market cap, because these are utilities, there's a question about, are they securities or not, was less than $500 million. Today, it's well over 40 billion in that space. The stablecoin market, we haven't talked about this, but there was big news yesterday regarding Tether. Tether settled. Tether grew from less than 2 billion, I think, in 2019 in outstanding to 35 billion today.
Pat, while we're on that topic, could I ask you, for the audience's sake, could you just let them know what they settled about?
So it's very complicated. It's been going on since 2019, but I'll leave this to the attorneys, and maybe David can give more insight here. But basically, Tether has, right from the onset, which was back in like 2015, 16, stated that they were backed 1-to-1 for every USDT, which is the stablecoin that Tether has. It was backed by a US dollar. So in a bank account in the Bahamas somewhere, and or various bank accounts. And the New York AG went after them and stated that wasn't the case, to the tune of about $850 million. And at the time, that represented almost 40%, maybe a little higher, of all outstanding Tether. So that was settled yesterday for $18.5 million with Bitfinex, which is also tied to Tether. And there's been a lot of institutional concern about that, due to the fact that what happens if Tether shuts down? and there's this $30 billion of stable coin. What's going to happen to it? So that's been settled there. That shows an improvement, maybe tied to a variety of what's occurring in DeFi, that the regulators and maybe the Treasury are getting more comfortable with it. But I may have gotten some of that wrong, I hope, David, but correct me.
No, Pat, I think for our group at a high level, there was this concern, and it was documented by the fact that Bitfinex and Tether had an issue reclaiming about $850 million of proceeds from a bank that froze their funds, and then it wasn't clear where the made-up funds came from. And so for some reason in New York, and I would think a federal entity would pursue this, not a state one, New York pursued an action against Tether. The real headline here, though, is that, as Pat said, the money has been repaid. And so this is no longer an issue, and a fine has been paid to New York. But the real headline is that people need to think that Tether is sort of like the dollar to securities exchanges. Tether in many places is the unit of value that people trade into when they move out of one token. So if some people want to sell Bitcoin and they don't want to go into another token, Tether is sort of that unit of value that a lot of investors were going into. And so questioning the viability of that sort of reserve stablecoin, as we'll call it, really had a little bit of cast some doubt on the market. But now that that's been resolved, it's a very bullish thing for the market, because people are now convinced or more comfortable that Tether is truly backed by dollar deposits.
I want to ask one of the questions we often get as well, David, and I want to open this up to the panel, and then I do want to hit some of the questions that we're getting. For a long time, we've been talking about crypto, retail, and the institutions are coming, and I would argue that we're really genuinely seeing that now. From the DeFi perspective, is it a retail game, David, or is it an institutional game, or both?
Well, so it's really funny you say that, Ron, because I think it's both, but the flavors are different. For instance, on the retail side, you can have almost instantaneous access to credit instead of going through a bank or a financial institution, which for whatever different reasons will measure your credit, some quantitative, some other basis for which they make. But on a DeFi platform, it's really all about what you own. If you have value, you can use some of these platforms and get some level of credit based on that value. And it doesn't matter where you're from, what you look like, who your name is. If you have the value, you get credit. And so in some ways, this truly democratizes credit and takes out some of the, I don't like to use the word biases in these contexts, but takes out the ambiguity in this context with regard to credit.
It takes out the inefficiencies of the back office in a traditional brokerage firm where the margin clerk phones you to have you post additional collateral, as opposed to you having put that collateral into a smart contract that executes regardless and shows no mercy. They will do it, and they will do it now. So that's great. So it takes out inefficiencies, but there are other issues. There are risks of the smart contract versus risks in the traditional world, which have been around since but the issues have been around since 1933, Reg T. So here's your Reg T margin. That's what you got to put in. But realistically, DeFi is attempting to provide owners of assets the ability to leverage those assets or utilize those assets for other purposes while still maintaining exposure to the asset that they own. I own Apple shares in my brokerage account. It's in a margin account, so I know that half of it is lent out, maybe. So, but that's what you're trying to do. So there are risks and things like that, but but it comes down to, both of them are daily marked. One of them is executed immediately if you've got a problem, and liquidated immediately if you can't, if you're over, if you're under collateralized. On the brokerage side, it's a little more little more malleable, and you have a delay in the receipt of extra funds. You know, my broker phones me and said, "Oh, I need an extra $10 to put in the margin account." "Oh, okay, I'll write you a check, or I'll send you an e-transfer, or I'll send you a wire." "All right, well, oh shoot, it's 4 o'clock. I'll do it tomorrow."
Is it as simple, and a dear friend Ben, who's joined us, is asking some of the more provocative questions. Is it as simple as DeFi is fully collateralized versus mainstream or traditional finance, which is really partially collateralized? Is it that simple a delineation?
Well, no. I mean, DeFi is a lot bigger, right? I mean, there's coins over $1 trillion, right? You know, we have 40+ billion locked at this point in time. It's not fully collateralized. You can collateralize your positions, and the more, you know, it's just supply and demand. More of a certain token that goes into one of these platforms, the interest rate, the yield goes down, and they're determined on a daily basis. Frankly, it's real time. So a yield may be 28% today, maybe 26% tomorrow on a certain token. Yeah, it's not fully collateralized, but I mean, to David's point, it gives you the opportunity to collateralize. One other item I'll just mention, because you had asked about institutions, and David had shared it's both. I agree. And I'm not, you know, this would be for another discussion, but many of us have talked about and heard about yield farming and what's occurring with institutions. They're utilizing these DeFi platforms extensively, and the returns are phenomenal. Just year to date, I'm familiar with several hedge funds that are focused on DeFi investing, who have returned close for a couple of reasons, not just yield farming, but what's occurred with Bitcoin prices and ETH prices, et cetera, have already achieved 100% returns in their funds.
Pat, let's stay with that, and I'd love to get perspectives from the rest of the panel on one of the other questions. To that point, these speculative bubble returns, leveraging tokens that have no underlying value, it's the boiler room pink sheets of the 21st century. Someone weigh in, tell me why that perspective may or may not be wrong. And David, I'm going to call you first.
Well, look, I think you're building these trading platforms, and there are incentives to get people to trade on the exchanges or on the platforms and create liquidity and create value. So if you have a marketplace where people are doing more and more trades on your marketplace, the token that supports that marketplace is going to become more valuable. Like the example I like to give is Uniswap. Uniswap, what is it? It's a matching engine. It matches different tokens, and it provides a price and liquidity. Uniswap started by giving out free tokens, or airdropping tokens to people who use their platform. They gave, some cases it was 400 tokens per wallet that use their platform. There's value because there are fees that are created through each transaction. Now the usage has gone up substantially. The amount of tokens locked on their platform is substantial. There's a lot of value to it, and that value is expressed in a token price that's over $20 or $25 and has a market cap of $2 to $3 billion. So I see that as one tangible way to show you an example of a token that has usage, that has value locked, and in the marketplace is being valued at a certain number. We can argue what the token price is really worth, but the way I like to see it is that people right now today are trading it on the platform in high volume and are willing to pay approximately that price for the token.
Anyone want to add to that? I've got a couple more questions from the audience. Okay. David, let's stick with you for one moment because I want to get a little more granular. One of the questions that came up, and again, it goes to yield, it goes to return. DeFi platforms are providing 8% interest for USDC. How is this possible? Can you work through or talk through a little bit of the lend borrower dynamics of and again, not advocating a Nexo or some of these other platforms. What does that look like?
Well, I mean, in a few places, like anything else, different platforms want to get users, they want to get volume, they want to create liquidity on their platforms. So they've clearly done some analysis and they've realized that even for stable coins, they can pay this type of interest and still maintain a successful business. The ideal goal, though, is you need the stable coins to have a trading partner for the different tokens that you want people to trade on your exchange. I would say there's a finite amount of people who will want to swap. I'm going to take 2 tokens, for example, like people who are going to want to swap Cardano for Uniswap. Like they might just not have a reason to do that. But you need a lot of stable coins if somebody wants to swap their Cardano for Tether, their Cardano for USDC. And also you need to have different options. So you want people to go to your exchange, you need to have liquidity in a number of different tokens. So the reason why I think they can offer that, Ron, is that because by getting that liquidity, the stablecoin liquidity, you create trading pairs, and then the fees that come out of those trading pairs for trading on their exchanges.
Or as a colleague entered into the Q&A, so DeFi is a blockchain pawn shop for crypto.
You know, not necessarily. In some ways,
a little.
Yeah, in some ways, really, DeFi in some ways is a mature eBay. Instead of being a marketplace for goods and services and what value you ascribe to those goods and services, the first layer of DeFi is trading one asset for another asset. And then the second layer, which is different than eBay, is you have the opportunity to, participate in getting some of the fees from the trading revenue and things like that by staking the tokens.
Right. So it automatically adjusts the value, or not the value, but the potential value of the asset that you're pledging versus the demand for others to use it for whatever reason, and the rate at which you will get paid for posting that. Not dissimilar, in fact, to and actually only just recently, where people holding stock in a margin account that might be a highly demanded stock to short, the broker makes all the vig.
Mm-hmm.
The individual makes nothing.
Right.
And now, only in the past few years, have brokerage firms decided to pay a SNC of their P&L to the long client. On most instances, on most stocks, it means nothing, because most of them are long S&P, and that trades as general collateral. But if you're looking at GameStop or other highly shorted ones, you could be looking at 40, 50, 60, sometimes 100% or more annualized fee to borrow the name.
One or two more questions here, and then I want to move forward into some of the legislative and regulatory. And Richard, I'm sorry, did you have anything you wanted to add to that last point?
Only one other comment, that I think Greg's right. For retail brokers, that they've been keeping the margin fees completely, but there's a huge business where large asset management firms, especially index providers, who are basically just long the index, lend out their securities and get paid that way. That's a big reason why they're so successful and they're able to track so well the indices or even do better. But yeah, it's a minor point.
So this is a bit of a granular DeFi question, and I want to go into it a little bit. Would a decentralized DeFi blockchain have a utility token for staking nodes on the networks as well as a security token, or am I confusing terms?
Support.
Can you repeat that question?
Yeah, ask that again.
Would
write that down. Send me a fax on that, will you, Ron?
Yeah, I may have to write that down and fax it over there. Would a DeFi blockchain have a gas token or a utility token for staking nodes on a network as well as a security token? Is this, and I think the argument is this a bifurcated, can you have a token that powers the DeFi chain? Can you have a security token that finances the DeFi chain?
I'm gonna, and this will fast get out of my bailiwick, but Maker has DAI.
Yep.
And it has the Maker coin as well, does it not? Is anyone really familiar with Maker? So perhaps that's the answer to that question. I'm not sure.
Understood. Well, thank you all. Let's move forward. Go
Well,
ahead.
can I just jump in?
Yeah.
In regards to, I think what that question was, in regards to there, it's not a DeFi blockchain, right? It's the blockchain, however we use
Or a
it.
blockchain, right?
Right. Bitcoin's not DeFi, so it's but it utilizes the blockchain. In regards to digital security, and I think Richard and I are in this space. That's heavily regulated. So that yeah, at least here in the U.S. it is. There are other projects, Polymath's working with many on a global basis. So that's not regulated, and it works very well. So I think that in regards to that question, just to take that part on the digital security side, excuse me, and Richard made this comment at the onset of this panel. There are a lot of great ideas in DeFi that a lot of smart people, I'm not including myself in that, but guys like Richard and others are trying to figure out in regards to how you take that DeFi and move it to traditional finance. And there are many, many great ideas. I think over the next 6 to 12 months, many concepts on the DeFi space will move over into the traditional finance in the form of digital securities. I
think Pat's being very coy there. I think he'll be giving us some announcements in the next 6 months, I think, over there. But I think I don't want to gloss over this question because I think it's a really good one. Talking about combining security tokens and DeFi, it's happening already. You've got Maker. So Maker was originally set up where you would deposit ETH and withdraw DAI, which is their stablecoin. You can now deposit security tokens into Maker, which are generally more stable, so you don't have the kind of as much risk as being liquidated or whatever. So they're doing that already with some real estate properties, I believe. And then Compound has Tin Lake. Tin Lake is adding security tokens, which are very short-term assets, such as accounts receivables and things like that. So we're beginning to see that merging going on, which is very exciting.
Thank you, Richard. Thank you all. And again, please keep the questions coming to our colleagues and friends in the audience. I want to address this next question because it segues into the kind of regulatory considerations we've all had. And there's no shortage of any of us in this conversation who've had to deal with regulators over the past 20, 30 years. And the question was, does the panel see that at some point in the near future, DeFi can potentially be placed to launder ill-gotten gains or ill-gotten cryptos? What controls are or should be in place since the DeFi exchanges are fully decentralized and automated via smart contracts? That's a mouthful, and I would argue, and I want to kick the conversation off with, everyone's still trying to figure that out. It is this kind of very broad square peg round hole conversation, not least of which because I would argue legislators and regulators, while catching up, aren't on the bleeding edge of DeFi, for example. Let's open that up a little bit. David, thoughts there? You and I have spoken to regulators in the past. Where does that go from a regulatory and legislative perspective?
Well, in the first instance, there's this sort of old, I don't know what the right word is to use, but there's this sort of old narrative that's just still been hung on to crypto that is, it's just, nothing meaningful is done except money laundering and this and that. And we've seen from the Chainalysis report that that's really not the case. The way I look at these issues is that typically the fiat on-ramp and off-ramps provide a place for KYC and AML, and those are places where you'll see some of that go on before you get into the DeFi ecosystem. But I personally believe that this is just sort of, just a legacy issue that's been raised a bunch of times. I think we always have to remember fundamentally, anybody, even novice to blockchain, knows that transactions on the blockchains are immutable. And are you really going to want to enter into certain transactions that are immutable and with, good analytics services can be traced? So I think if anyone had nefarious ideas or purposes, like the last place you'd want to do something is somewhere where every step that you've taken in the process can be tracked and traced.
I want to push on that just a little bit, David, because I think one of the things from the perspectives of smart contracts, for example, that's brand new territory. And I would argue from a legislative and a regulatory perspective, even from an audit perspective, that really some of the infrastructure and framework to do that now falls a bit short. Pat, Greg, Richard, I want to open that up a little bit more. Again, none of you have any shortage of dealing with regulators and hopefully not too many legislators, but thoughts there, and how does that evolve over time?
So in regards to working with the regulators, we view them as partners. They obviously regulate, so they have a, the SEC and FINRA are guardians of our financial system, along the OCC, et cetera, all the others here in the US. And they're doing their best to staying ahead of this typhoon of DeFi and what's happening as best as they can. In regards to smart contracts, I'm not a techie by background, but actually a regulator shared this with me about a year and a half ago. And I was describing what a smart contract was, and their response was, well, it's just basically coding, right? And they're absolutely right. It's code. And the important thing about smart contracts and coding is that in regards to our discussions with the regulators, that smart contract cannot be altered. It cannot be changed. Who controls the smart contract? Who controls the coding? It has to, once it's issued, it can't be changed. It can be swapped into a new smart contract if there's a problem, et cetera. But that was the component that I found very interesting and got me excited about this. And it was a regulator who opened my eyes to how to think about smart contracts.
Thank you, Pat. Richard, I want to just to kick that off, because you've just come through the mill of dealing with regulatory filings and regulators, and we've seen the evolution of FinHub and FinCEN and CFTC and the others who have really begun to mount the education curve and do really understand it at a granular level. What's your perspective? Do they get it?
Yes, I think I like the FinHub a lot. I love that it has been elevated to a full department or whatever. And I think Valerie Stepanek is doing a good job over there. Although, notwithstanding, it was a fairly intense process we went through it, as I'm sure Pat did. But I think the topic of regulation and DeFi is very important, and I don't think anyone has a good idea of how to do it right now. Hester Peirce just yesterday or 2 days ago came out saying something like DeFi is really going to test the regulators on how to deal with these things. Another thought, so DEXs, decentralized exchanges, they pose a very specific challenge because you can trade on there without being KYC'd. You're just a wallet address at that point. And do anyone remember Ether Delta?
Yeah, sure.
Yeah.
One of the first decentralized exchanges, they got shut down. Like I can't remember exactly the reason here, but they got shut down by the regulators because there was some part of their setup was they were operating illegally within the regulated framework, and other decentralized exchanges set themselves up based on that information from that lawsuit to specifically avoid the same kind of trap that Ether Delta fell into.
Ether Delta was, it was nailed. Well, actually, they couldn't nail the company because you can't go after a smart contract.
Right.
So what they did is they ended up threatening the main coder, and one of the points, if I remember correctly, and David will please correct me if I'm incorrect, is that was that individual or group of individuals benefiting from the writing of the code being paid in some other way? If that's minimal, I shouldn't say this so emphatically, but presumably if the more somebody is involved, the SEC is going to go after somebody or an entity that it can point, that it can put its finger on. And I suspect that DeFi is threatening to that extent, and that there is really, all depending, is there anyone to go after per se? And where are they? Are they in the United States or are they elsewhere? It brings into other into play other issues like extraterritoriality, but we're not here to discuss that. But there's a lot of things that they're that that are that they're kind of afraid of. I think where they will, I think where they may be happier is that I suspect, and and I've heard this empirically over the past few days, is that some of the traditional finance companies are looking at embracing DeFi. They're not running like crazy into it, but they're looking at it simply, and I think it's largely because in the same way as offering offering custodial services for Bitcoin, now their clients are saying, okay, I want to actually use that Bitcoin. I want to lever that. I want to have the same ability that I do with my shares that you as a prime broker are holding on my behalf. I'd like to have some sort of collateral value for that. So it'll be interesting to see how that evolves. I think, and I don't know necessarily. Some people may think, is it going to be, I get rid of things like prime brokerage and whatever like that? And I think no, prime brokerage is going to fully exist for larger institutions as it does today with those assets, and the demand pull from the client is going to push that in some ways towards some of the financial institutions. So that'll be interesting to watch, like I said.
Are we looking at, Greg, just on that point real quickly, we talk to a lot of lawyers, you and I, and a lot of folks that understand things like, the Investment Company Act, the acts of 33, 34. And for a long time, it seemed that they were looking at what's happening in the world through the lenses of those original definitions. Pat, are we talking about how we reinvent the definition of an exchange or an investor or a vested interest or economic? Because that doesn't map well to some of the innovations we're seeing happening.
Mm-hmm. That's a great question. I haven't thought about that in those terms, rewriting the rules. I view this more as an evolution of technology, not a revolution. Yep. And, the comment was made earlier. I mean, I remember the days when I'd go down to Wall Street, there'd be runners all over, carrying, documents in those big heavy duty bags. And and that wasn't too long ago. And then we moved to the electronic trading. And, what occurred was the UI, the user interface over the last 20 years in regards to Robinhood and Charles Schwab and all has gotten fantastic, right? And we use our phones. But the infrastructure hasn't changed really from the 70s. And that needs to be upgraded. So when you say rewriting the rules, I view it as an upgrade in technology. It's needed. DTC's white paper today that it suggests that they've been working on for many, many months shows it. I think it's an issue of it's not an issue of if, but when. And I think you started, Ron, by saying it could be a decade away. It could take 10 years. But it took T plus 3 to go to T plus 2. It took 23 years. Right. Now this would be 6 years if that Q2 2023 by DTCC is accurate, which, we'll see what happens there. But to me, it's an evolution. It's just a new technology upgrade. And, using it, just the cost savings alone are going to be tremendous. And again, just to the earlier comment by Greg regarding prime brokers, et cetera, look at what happened with decimalization and look at what happened with the uptick rule in 2007. I mean, the players out there in the market, currently the market makers, the prime brokers, the clearing firms, DTCC, they're all going to figure out how they can survive. And they're going to be part of this going forward. That would be my only comment to that.
And Pat, and for any regulators who are listening, we are absolutely not advocating rewriting rules or getting rid of the old rules. I agree with you. It's an evolution. We've got a whole bunch of questions coming in. I'd like to...
Ron, I'd like to jump in and make one point.
Yeah.
I think this is also a time to reflect on what type of things do actually really need to be regulated and what type of things don't. If two parties are exchanging two tokens on a platform, does it actually need to be regulated? Does somebody actually need to be there? If those trades are being done, if those swaps are being done, my wanting to swap Cardano for Stellar, do we need somebody to be overseeing that? I think as the technology evolves and as the capabilities evolve, I think we also have to examine where our regulation is most efficient and most in best use, and in other places where it may not be necessary anymore.
Good point. And I mean, that I don't want to call it a libertarian perspective. I mean, when you and I, David, have talked to regulators many times, and if you point at something, there's probably a regulator who thinks it needs to be regulated. It really is a fundamental shift in what do we mean to accomplish by regulation in the era of these new technologies. Great conversations, everyone. I do want to address some of the questions where we can, and then give you all a couple moments for the last word. And we're going to be going back and forth across the span of the entirety of this event. One of the first questions we got was, what's the best thing to read or to follow to understand and keep up to date on the latest developments on DeFi? What are you all looking at from a sources and an information perspective? I know we all read a lot, but I'd love to hear directly from all of you.
I would say personally, I look at all the new lending platforms that come in and I read their Medium posts and then I go on them and I attempt to use them. Yeah. And I think reading in the abstract is great to help you understand the thesis and ethos of the different platforms. But I think, again, you don't even have to risk real money, so to speak. Like, I just think trying them out and seeing how they work is really the best way to learn about them.
There was an interesting article, a paper by the St. Louis Fed on DeFi. And it came out, I have it up right now. It came out 3 weeks ago. 65 pages for your weekend reading. It'll give you a decent look at it, and then, talk and then look at, the actual platforms and see how it works, but that'll give you a really good view. And, it's from a respected source.
Yeah, and for any of the attendees, we have that article. We've shared it publicly. If you don't have access, just email us info@wsba.co. We'll get the article and the links to you as well. Couple other questions. Charlie Moore asked a great question. Are naked shorting controls the Trojan horse to sell digital securities to regulators? I love any. Yes, go ahead, Richard.
Love that question. Yes, absolutely. Never waste a crisis.
Never.
I agree.
Oh, goodness.
Yeah.
Let's move forward. Also, a couple of others. Does our panel think that the GameStop saga that we talked about earlier in the presentation will have an impact on the Biden administration? And I would argue that's an interesting question, given that a lot of the prior regulatory notices of public rulemaking have been put on hold. Pat, Greg, Richard, David, thoughts on how the Biden administration approaches this, and with Gensler not even being seated yet at the SEC?
Well, I think a lot, just in regards to your earlier question, it's a perfect segue into this about education. Gary Gensler, and it's online, did a course at MIT in 2018, fully recorded, with presentation docs all about cryptocurrencies and the blockchain. If you want to learn about DeFi, and I highly recommend it. I wish I was one of those students. He is very educated in this space, and he will it seems he will be stepping into that role. So I think, his reputation precedes himself in regards to the CFTC and what very regulatory focused, enforcement focused. And I think that's what we'll need to expect. And in regards to the Biden administration, I think everyone has eyes on this. I'm sure there's going to be another crisis in the next month or two, and then this is forgotten. But Gensler's what he did at the CFTC, I think we all expect to see with the SEC, very focused on regulation and enforcement. But that course, I think we've talked about this. It's fantastic. It's like 18, maybe 20. If you want to learn about DeFi, you want to learn about this, I would do a binge over a weekend sometime.
It reminds me, we probably should have shared those links in the St. Louis Fed to the materials we shared with attendees. We'll get those out to attendees as well, Pat. So really good. Thanks for referencing that. Any other comments before I move forward? Okay. So our friend Ben, ever the provocateur, is yield farming simply an ICO by any other name? I always love these questions. End result is that the DeFi provider gets their token into the hands of individuals. Someone weigh in before I start deleting his questions.
Well, I think inherently no, because when the ICO sales, you are buying a token of a project. In this case, you're typically, having another token like an Ether or another token, using the token of we'll call them token X,
yeah,
and then staking them to get yield from that. So you're actually getting something from buying the token, whereas otherwise you're only getting speculative value, theoretical speculative value from the ICO in and of itself.
Yeah. Excellent. Thank you, David. So I'm going to make this the last question. Then I want to open the floor to give you all a few moments about final thoughts and what's coming up. Is it foreseeable that corporations, and I love this question because the five of us can talk about this for hours as well. Is it foreseeable that corporations will set aside a portion of their corporation cash into BTC or Ether and to place them into DeFi for yield? And we're seeing that shift. We're seeing balance sheets and corporate treasuries holding these to the chagrin of several others. But does that move into DeFi? What does that do to the kind of adoption?
Is that not the natural extension for custody of a reasonably quality asset that has liquidity and value?
Right.
So the answer to that, in my view, is yes, over time, not tomorrow.
Right. Pat, want to add?
Yield farming is highly complicated. It's very mathematical. I've spent time in it. I couldn't do it on a regular basis. So I would think that there will be asset management firms out there that will offer those services to those corporates to provide that. Because you are locking in, but it's a series of steps from what I've seen. I mean, you could do some of the examples that were given earlier, but that's one step or two. A lot of these sophisticated funds are going down the path of 10, 20 steps to lock in very high yields.
Yeah. I do want to go back, Greg, to that one point. I want to push on that a little bit because I agree with you in principle. But when we look at corporate treasuries, they really do have the challenges in basic crypto around things like fair market valuation. And a lot of those sit on the books and records as long-lived intangibles, if I remember correctly. That becomes more complex, and it shows you I talked to way too many accountants, but that becomes more complex when things move into DeFi from a corporate treasury perspective. I would argue.
Oh, okay, sure. From an accounting and tax perspective,
Yeah,
sure. I don't think, right now, I don't know if there's any clarity anywhere in the world. But yeah, I'm sort of combining the corporates with the managers and other entities that firstly are now demanding exposure to Bitcoin, ETH, and perhaps a few other coins, and they are demanding of their custodial banks that hold their equities and bonds and everything else to look, I want to own this asset, please allow me to, or I will go elsewhere. The natural extension then from that is, as it was in the securities and bond world, okay, now I want to repo my bonds out. So you have a repo desk, please do it, and I will take a SNCC. Or you have a securities lending desk, please lend out my securities, and I will give you or whatever. So yeah, I as I mentioned before, I do see that happening.
Fair point. We've only got a couple.
Makes perfect sense to me.
No, Greg, I appreciate it, and I agree with you. We've only got a couple of minutes left. I always learn chatting with all of you, and we could do this for hours. David, I want to give you the first shot at the last word and go around the horn and get everyone's perspectives on what's next for DeFi. What should we be thinking about going forward?
Look, I think DeFi is the training ground for where you see a lot of the changes in centralized exchanges. So I think in DeFi, you'll see two things going forward. You'll see continued innovation, offering different products and services and seeing what resonates with their customers and what resonates with people in general. I think that you're going to continue to see attractive yields, maybe not at the levels we've seen now, but yields attractive enough that investors will want to put their money on those platforms. And I think the last thing is that we'll see some lessons learned. I mean, yes, there have been some exploits on some of the platforms, so I think they're going to just become savvier, invest a little bit more on their internal infrastructure so that we see a more secure DeFi ecosystem.
Thank you, David. Pat?
First of all, I'd like to thank you, Ron, and David, Richard, Greg. It's been terrific being on this with you. Very, very much so. I said earlier, I think it's going to be a fantastic year for DeFi, for digital securities, for further evolutions in traditional finance. I think that when my only comment here, and we didn't have a chance to talk about this, is Coinbase is rumored to go public. So when Coinbase goes public, that's a lot of DeFi trading or tokens trading on Coinbase. I think that and that's a traditional IPO or direct listing, whatever they may do, at a very high valuation. I think that'll bring further credibility to the DeFi space, and more institutions will get interested. So I see that as a milestone moment for the space.
Thank you, Pat. Mr. Murphy?
I echo Pat's gratitude for being on the panel and for the great discussion. As I said, I think DeFi is the attempt at trying to squeeze value from a largely inactive asset up until now. The questions, and I don't say they're going to kill it, because DeFi is going to move forward, as I've also mentioned. I think there's a lot to be discussed about the individual nature of the risks, i.e., smart contract risk. You have different platforms that have different types of structures and pricing, whereas in the centralized world you have, well, at least in North America, you've got the rule. So there's a lot there that can be unpacked in terms of a constantly evolving, on a minute by minute basis, as Pat mentioned before, on the value of which you are depositing and what you're getting back. I think it has the ability to streamline back office, to help in the settlement of tokens overall, and I also think it has and expanding that into the GameStop thing and whatever else like that. I think it has a great deal of ability to avoid problems like that on the settlement side, especially. And ultimately, the more assets that are quality assets, potentially, as Richard mentioned before, stable price assets, security tokens, for instance, that are, whatever, and there'll be the high quality and low quality, and everybody can determine what margin they want to give on that. But I think all of those are going to flow in over time.
Thank you, Greg. And Richard, I want to give you the last word.
Thank you, Ron. Thank you to the panelists. A great discussion here. This is so exciting. We're right at the beginning of this. DeFi as a word wasn't even around 2 years ago, and now we're all talking about it. We're just at the beginning. There's so much more to go on the DeFi side, of bringing it into the regulated securities context. I think there's some key issues people need to be thinking about. Gas costs are creeping up really high right now, and that could be a problem. That's a potential opportunity for other blockchains to kind of take over from Ethereum, like Polkadot. We need to be watching that stuff.
Exactly.
And we need to think about, we're talking about, we can, even by blogs, we can fix market structure, not if the transaction speeds are that slow as well. So there's a lot more work to do. But there's a lot of innovation still coming out, whether it's proof of stake chains, side chains, other things like this. It's going to be a fun year, as Pat said. It's going to be a fun decade here.
Thank you all. I'm going to leave it there. Like every good conversation, we've gone a little bit over. I've said it many times. I hope you all know it's such a privilege to have you all as friends and colleagues. Thank you for being part of this. For everyone who attended, we will make this recording available in the coming days, and we will make resources available in the bios for all of our participants as well. We'll leave it there. Until next time, everyone, thank you so much for joining us.
Thank you,
very much.
everyone.
Thanks, Ron. Thanks, everyone.
Bye-bye.